Good morning, everybody, and welcome to our webinar around ESG and sustainability. As you know, this is the 6th webinar in our series, and over the first 5 webinars, we talked about getting started and working towards that very first sustainability and ESG report. Now, today we are saying, what about assurance over that sustainability or ESG report? And we have also invited along one of our tax partners to talk about a very hot topic, and that is, how does tax governance relate to ESG? So tax governance part of the G in ESG, so we'll also be looking at that. So welcome to the webinar. So we've got 4 presenters today. I think Ashley and I have realized that our attendees have had enough of us, and therefore we thought we'll bring in some better entertainment. So David Blake, a tax partner based in Melbourne, is joining us today. And then we also have Anna Espinal-Ray, who is a director in our National Audit Quality team, to talk about assurance over sustainability and ESG reports. So welcome to David and Anna. And as always, welcome to Ashley as well.
Thanks, Aletta.
Ashley, I'll hand over to you to talk about our upcoming sustainability webinar. So we have received some really good feedback, some requests. Don't stop now. It was a series of 6. This is a 6th one. Please don't stop. And therefore, we've scheduled another 3 before the end of the year. And we're already working on a series of webinars for 2023 as well. So we'll communicate that as soon as possible. Ashley, did you want to talk about these 3 webinars?
Of course, I'd love to. I thought you were going to keep going, but that's all right. I'm happy to take over. So as you can see, well, I mean, obviously to date, what we've done is we've tried to run through the kind of ESG activation process. And so the genesis of the 6 webinars is to try and describe the life cycle of the ESG journey. What we're doing now is we're kind of taking a look at some specific discrete topics that pop up regularly in any kind of discussion around ESG priorities and ESG key focus areas. So decarbonisation is a big issue, carbon reduction, emissions reduction, and so we're going to be talking about that in October. ESG linked remuneration is also becoming a very popular issue, and we're going to talk about that in November. And then due diligence. So what does it mean for transactions when organisations buy or sell other companies, and how important is ESG and all that? So just a bit on each of those. So with the decarbonisation one, so this is all about the impact that we're having on the planet and the extent to which carbon is changing things either in the short, medium or long term. So what this is about is understanding, I suppose, what decarbonisation is or what carbon reduction is, looking at some of the market conditions that are impacting it, and talking about how organisations can develop carbon reduction plans and even why they should be developing carbon reduction plans. So as always, is there a business case for this? Is there an opportunity here? Yes, there is. I think what works really well here is taking a practical approach, and so we'll share some kind of practical examples of where this has been working well for certain organisations and what a typical roadmap might look like for that. On the ESG linked remuneration, that's a really important topic as well. And so this is where organisations, particularly boards and directors, are looking at success as something other than just profit and reputation these days. And so these broader ideas of sustainability and stakeholder engagement are becoming more prominent. And so how do you link that to, I suppose in the first instance, executive reward structures, but not just executives, probably employees more broadly. And so there's obviously challenges around this, there's opportunities around this, there are certain ways that people do this, there's certain targets and rewards, and what we're going to do is look at some of the examples around that. I think what's really interesting is this is something that has already started to take place, and it's certainly really popular in the US. Earlier this year, in February, many of you would know Salesforce is one of the most popular CRMs around at the moment. They announced earlier this year, for example, that they were going to tie a portion of their executive bonuses to ESG targets. So this was for executive vice president and above. And they kind of said, well, what we're aiming for is 3 specific things. We're going to look at equality. So how do these execs increase the representation of minority groups in the workforce? We're going to look at reducing air travel emissions, and they were aiming for less than 50% of their baseline, which was financial year 20. So how do the execs generate emissions reductions in air travel? And then how do they increase their spend with suppliers that have basically signed up to their supplier terms, which includes kind of the supplier's own commitments to greenhouse gas emissions. So really interesting. MasterCard's gone one step further. Last year, they announced the executive linked remuneration. This year, they said, no, all employees now have their bonuses linked to ESG targets. Again, they're focusing on emissions reduction, they're focusing on gender pay gap, and they're focusing on financial inclusion. So this isn't just a fictitious idea. This is happening, has already been happening, and will continue to happen more broadly. And then finally, due diligence is a really interesting one because investors, lenders, other people, they're all placing more emphasis on ESG practices and supporting strategic important decisions. This is running alongside traditional financial due diligence. And so now you've got organisations that are conducting financial due diligence on a business, tax due diligence, IT due diligence, cyber due diligence, payroll due diligence, ESG due diligence. These are all markers of short or long-term value. And so it's really important for organisations to understand why you would want to understand the ESG performance of a business and how you would go about evaluating it. And so that's the purpose of that third webinar. So hopefully one or all of those are of interest to you or someone else in your business, and you can join us for those, or you can recommend that others in your organisation join us for those as well. That's probably enough on that, Aletta.
Thank you very much, Ashley. And I think I should also say that the interesting thing about sustainability and ESG is that this touches so many areas. And therefore, today we've got David from tax here, we've got Anna from assurance. For decarbonisation, we'll get experts in that space. For ESG linked remuneration, we'll have Alan Feinberg, who looks at remuneration and reward. We'll have Janine Waters, who looks at people advisory. For ESG due diligence, we'll have some corporate finance partners join us who work with deals and transactions. So as we go along, more and more people get involved on this journey. And I think we've always said it's about activation, and ultimately we believe that this will be, sustainability would be embedded in the strategy of organizations. And therefore it's not surprising that we're now getting a lot broader perspectives across organizations. So very excited to get other people to contribute to the conversation. So really looking forward to that. Thank you, Ashley.
No problem.
Then if we go on to assurance over your ESG report, so I thought I'll start with progress to date. So yes, you've prepared a sustainability or ESG report. So from webinars 1 to 5, we've gone through our roadmap and we said, let's do a stock take of what we've got in place. Let's see who are our stakeholders, what are they interested in, do a materiality assessment. Let's develop our strategy, ESG policies and procedures. Let's gather data. Let's put processes in place to gather data. And in step 5, we finally get to our sustainability and ESG report. We said all of this was driven off the business problem that the market is telling us to get access to capital, to get access to markets, to get access to people. We need holistic communication. And that holistic communication is no longer just prepare financial statements in accordance with accounting standards that give us the financial numbers. We said if you really want access to people, and if you want access to markets or customers, and if you want access to capital, you have to convince a broader range of stakeholders about the value of your organization. And therefore, to complement these financial statements with sustainability reports, ESG reports, and at this stage, those reports are voluntarily prepared in Australia. But we've got 2 documents sitting side by side. We've got financial statements and we've got sustainability reports. There are a few differences between them. financial statements based on accounting standards, sustainability reports based on whichever framework you pick, and there's more than 500 available. Financial statements, the preparation of which is mandated. Sustainability report, at the moment, it's voluntary. And then the third big thing, and that's what we want to talk about today, is financial statements are subject to audit, reasonable assurance. Sustainability reports, ESG reports, at the moment, there's no requirement that those reports be subject to assurance. So in a way, the balance is slightly off. It's holistic communication, but one part of the holistic communication is being audited, and the other part of the holistic communication, potentially no assurance. So if we want to convince the market about the value of this information and that they should have equal prominence, one would imagine that both should be subject to some level of assurance. So if you look at the sustainability and ESG reporting options, we have discussed in the past that you could have your ESG sustainability information or your emissions carbon footprint information as part of your audited financial statements. I've recently seen a few examples of that. So it's part of the audited financials. It's been audited. Usually it's only certain parts of the sustainability information that's included in the audited financials, and clearly there's audit. Another option, the middle option, which is my strong preference, is that you include your sustainability report as part of the broader financial report. So in that broader financial report, we've got the audited financial statements, but we also have other things. We have director's report, we have the OFR, we have sustainability report. And therefore, in order to give some prominence around that information and the importance of that information, I do believe it should have some level of assurance. And then the third option is completely outside the financial report, so potentially issued at a different date, different time. And again, you know, if we issue that information, do we need some level of assurance over that? So, Anna, I'll hand over to you. I've tried to set the scene where we've got to. We've got a sustainability report. We've gone through our journey. We've prepared this report, and whatever we decide where we want to disclose it, part of financials, part of financial report, or separate, you know, over to you. What about assurance?
Thanks, Aletta. And that is really the question, you know, what do we do then with this report that we have that is available? You've gone through all of the process that Aletta and Ashley have gone through in the previous webinars, and you have this beautiful report. Why would you then want to think about assurance? Why are we telling you, here's an extra piece of process that you could actually do? And ultimately, it goes back to that question around who the users are and what kind of information do they need. Throughout the series of webinars, we'll have gone through effectively the really wide range and variety of stakeholders and people who care about ESG and sustainability information. So really, there's potentially a broader range of potential users of that information than there might be for your financial report. Obviously, a first option is you've got investors who are clearly interested in the link between sustainability and what impact that may have on performance of the entity. And so they might be interested in questions like whether your entity's risk profile fits with the risk return profile that they're looking for. And obviously incorporated in there, we're thinking about what ESG information is presented. The ESG report will also give them more information around whether you as an entity fits with their strategy around what mix of investments they want to hold, whether the values are aligned, and so on. So investors obviously are quite a straightforward thought that you might want to be able to provide them with some assurance that the information that you've produced around ESG is credible and trustworthy. You then have some more direct stakeholders, obviously not just the entity, but say if you're a family-run business or a large private entity, you know, as directors, there's probably an incentive to effectively make sure that the information produced is deemed externally materially accurate, reliable, and appropriate for the industry, for your entity, and so on, so that you know that you can set a strategy, an ESG and sustainability strategy that is actually fit for purpose. And then you might have other direct stakeholders like customers, suppliers, lenders, insurers, the rest of what you might traditionally think as direct stakeholders, and might care about different aspects of your sustainability report around whether as an entity you do what you say you're going to do, whether you look beyond just the entity when you're considering basically the place of you as an entity in society and what it is that you're trying to achieve. Thinking especially maybe about supply chain matters in the ESG context, and kind of will care very much about the trustworthiness of that information. And then other indirect stakeholders is when you think more broadly, you'll have the government, you'll have regulators, potentially charities who'll be looking at information produced by entities who are producing these ESG reports in terms of basically data capture to try and understand the landscape, the framework, to inform policy decisions, to try and really drive effectively society forward using that information. So because all of these wide-ranging stakeholders have really an interest in the information that's being produced, it stands to reason that actually making sure that there's some independent assurance that the information produced in that report is credible and trustworthy would be quite a good thing to do, really. Now, I'll caveat that by saying when we're talking about assurance, and probably this is because I come to this webinar with a quality hat on, assurance is not a guarantee of the 100% accuracy of individual elements that you may choose to report on. It's not a certification. It's not effectively an insurance process. It is assurance in particular. And Krishay, we've noted that sentence about not absolving directors' responsibilities in the same way as with financial statements. The preparation of the ESG report still stands, that responsibility still stands with the directors, even if an assurance practitioner who's an independent practitioner still effectively signs an assurance opinion. So having convinced you, obviously, that seeking assurance is a really great idea, it stands to reason that you may be interested in what the actual landscape looks like. What does that actually mean? Well, the key thing to note is that globally, the ESG assurance landscape is evolving quite fast. There are a number of standards that exist at the moment that would allow assurance practitioners to deliver assurance engagements. And more entities who are preparing ESG reports are actually obtaining this assurance for the reasons that we've just touched on. So there was a study by the International Federation of Accountants. They did a lot of research. They published a report. By the end of 2021, 91% of the companies that they looked at had actually produced a report on sustainability. And although only 51% of those companies had obtained assurance, that's still quite a large number, really. It's more than half. Most of those were in Europe, and I'll admit that the framework in Europe is quite further along. There's more likely to be prescribed reporting and prescribed assurance that comes with it. But really those numbers, we will only see those numbers increasing. Ultimately, as Aletta has framed, if you have two reports and you're obtaining assurance over one of them, you're probably going to want assurance over the other one because it seems like the smart thing to do. So the question then is, who is actually delivering this assurance? Who is actually providing assurance? Because we've talked about ESG, and like Aletta mentioned, actually in introducing the future webinars, it involves a lot of different subject matters. It involves people with a whole lot of different expertise coming together to be able to produce one report. Similarly, for assurance practitioners are commonly thought of as people who know about financial statements, who know about accounting standards, who know basically about numbers only, and only numbers that have a nice dollar sign in front of them. Whereas your ESG report obviously contains a whole range of metrics that you will have decided to report on. And yet we're finding that actually most of the assurance is provided by audit affiliated firms. That is by people who actually do audits of financial statements as effectively a primary reason for existing. And that's partly because we are the ones who know about assurance. We have assurance standards that are standalone standards that are basically work alongside systems of quality management to deliver assurance engagements that can give you the comfort that actually the work provided is giving you that standalone assurance that your ESG report is materially fairly stated, depending on which type of assurance you look for. We'll get to that in a minute. To get into the techie, geeky side, there are currently two standards that are available that assurance practitioners might look to in terms of delivering the assurance engagement. One of them is ISA 3000, which is really the core one. There is a work in progress at the moment at the international level, basically on developing a standalone standard to provide ESG assurance specifically. But in the meantime, there is already a standard that exists out there that effectively allows assurance practitioners to provide assurance on things that are not historical financial information, basically. There's also a standalone standard in Australia, and there's an international equivalent on providing assurance over greenhouse gas statements. So these two standards do already exist, are accessible, are available for use. Moreover, the International or Auditing and Assurance Standards Board, so there's the international equivalent of ISA 3000, the previous slide was showing the Australian equivalents, but the International Auditing and Assurance Standards Board have also issued effectively guidance on practical application of ISA 3000 on what they've called effectively extended external reporting, which was meant to encapsulate ESG reports, as well as any number of other things that you would report on beyond your financial statements audit. So there is that guidance available. It's non-authoritative, it is guidance only, it is an interpretation of what it might mean to apply one standard to your assurance report. So all of this to say, and I'll jump out of the nerdy detail shortly because that probably only interests those of us who are like me working in assurance quality. But all of this to say that there's a framework available that exists that if you were to seek out assurance over your ESG assurance report, there's a framework under which assurance practitioners can do so.
Anna, if I could just add for a second, I've worked through these auditing and assurance standards over the last few days, and in particular this international document. And the reason I wanted to include this in the webinar for everybody attending who are looking at preparing sustainability reports or along with a strategy, it's really important to get a view, or I find it really important to get a view of when the auditors come along, what will they be asking, what will they be looking for. This particular document that was updated in December 2021 has examples in it that were quite amazing. So a lot of words, it's a very lengthy document. Luckily, I love reading these lengthy technical documents, but some amazing examples around scope. And I found that interesting is, a lot of clients are saying, we've got a sustainability report. Maybe in the first year, we only want assurance over 5 metrics. And maybe the year after, we'll have assurance over 10 metrics. Maybe the year after that, it will be assurance over the whole report. And this document actually discusses, is it appropriate to only have assurance over 5 metrics? And it has to be certain key metrics, and how would an auditor assess that? So I think it's a really fascinating document to get an idea, how do we, when we prepare sustainability reports, get ready for the questions that our auditor colleagues will be asking. So I think it's a great reference, and thank you for willing to come and share some of that, Anna.
No, absolutely. I was about to say, we'll pick up on a few questions that you should be asking yourself before thinking about approaching someone about assurance, but in a minute, and hopefully that'll also give you a bit more of a flavour. The one thing I did want to touch on though is, having told you that assurance is not a guarantee, is not a certification, is not absolute, yes, this is spot on. I wanted to just clarify what options there were available in terms of what levels of assurance you could seek to basically obtain. And I'll point out though that the levels which are limited or reasonable, what differentiates them is the practitioner's work effort. It isn't actually the readiness of information. So basically, under reasonable assurance, that's what you think about when you have an audit of financial statements. That is effectively an audit where the practitioner is aiming to be able to express a conclusion positively. So to be able to say, based on the work that we've done, in our opinion, what we are being asked to report on is, in all material respects, reasonably stated. So kind of positive assurance, reasonable assurance. Limited assurance, on the other hand, it is negative assurance. It's basically, we've done some things, and based on what we've seen, nothing's come to our attention to suggest that it is misstated, but you can see what they're not saying there. What they're not saying is, and it is in fact reasonably stated. Now, don't think of that as a caveat. to allow you to go, well, our information is a bit iffy, it's not quite there, but we really want an assurance opinion because, you know, we've got this audited financial statements that has an audit opinion, so we really want an opinion over an ESG report. Now, what you can't do is say we can then just get limited assurance because our information isn't quite ready. Now, the reason for that is that the assurance standards basically say if you have reasons to believe that there may be a material misstatement in a limited assurance engagement, you have to go and do more work effectively to the standard that you would under a reasonable assurance engagement. So it's not the cop-out version. It is very much dependent on what you believe that your users would need and would require. You'll have noticed that I used the word in all material respects. And just pop back to the previous slide 1 second. Yeah, and materially misstated. Now, obviously, that touches on one of the key considerations around materiality. Now, similar to financial statements where there's materiality, and materiality in that context is often better understood, which is normally calculated as a number. It involves professional judgment, and there's also qualitative aspects. But basically, it's that threshold after which, effectively, in combination or individually, any misstatements or omissions would effectively influence the users if they were misstated. Now, that word user then becomes even more important. So going back to thinking about who your users are and thinking about that broad range of users, you can already start to think, oh, well, actually, the different metrics might need different materiality levels. And so that is probably also something interesting for you to think about as you're obviously producing these reports, which is at what level, how wrong am I allowed to be in this metrics? How approximate can this metric disclosure be and still be actually materially correct? And you'll see that actually, unlike in financial statements audits where there's an overall materiality for financial statements, most of the times here there's very much two aspects. One of which is what is the materiality of each element and what is the materiality of the ESG report as a whole. And that becomes quite important, especially when we're thinking about scoping the engagement as well. Aletta mentioned around an example in the EER document around effectively selecting what metrics you will request to provide assurance on. And depending on what metrics you will request, different materiality levels would apply. So before you go and then ask for someone to provide assurance over your ESG report, there are probably 9 questions or so that I'd like you to think about and make sure that you have answers for, primarily because a practitioner will ask them of you before they can actually accept the engagement. So because, like I mentioned, the assurance standards are still basically constrained by these quality management systems and effectively wanting to make sure that if an assurance practitioner has committed to provide an assurance opinion, they are actually able to do so. There are a number of questions that they have to basically understand to make sure that the information that is produced in the ESG report is in fact assurable. So again, by analogy to financial statements, if you didn't have systems in place that allowed you to produce a balanced trial balance and produce a set of financial statements that had complete disclosures in it, it's unlikely that an auditor would accept the engagement because they wouldn't have anything to audit. So it's the similar thought process, but because of the complexities of ESG sustainability reporting, the questions are probably a little bit different and a bit more detailed. The first thing is really to have quite clear in your head why it is that you want assurance. So the standards frame it as, is there a rational purpose for the engagement? So really, and that ties in with what the scope of what you've requested is. So if you've determined that actually you only want to report 5 metrics, the question will be, do those metrics make sense? Does it make sense that you would only want assurance over 5 metrics? Are you only requesting assurance over the 5 metrics that make you look good? Or are you actually providing a balanced scope? The next thing then to have clear that's very much related is who the intended users of the report are. So understanding very clearly what matters to those users and having maybe a matrix of those key identified users and what actually metrics they would be interested in would be a way of answering that question. And related to understanding who those users are is really understanding what their needs are. So government as a user or potential user of your ESG report will care more about future outlook to guide their policy decisions, whereas a supplier will care more perhaps about how you treat your suppliers. You also need to make sure that you've understood what framework or frameworks you are using. As Aletta said, there's probably about 500 of them at the moment, and mixing and matching is probably an option because they don't all apply to everything. but you need to be quite clear on what framework you're using and why, and that it is suitable to meet your users' needs. Also, once you've selected a framework, that you've applied it consistently, that you've allowed that framework to guide your ESG report into providing detailed enough disclosures that will actually be useful to the users. In order to do that, the next question to think about is whether your systems and processes that you have in place are actually mature enough to do so. And that's where that scoping question comes in around, really, are you able to produce the ESG report in a way that will actually allow it to be validated? Have you reached out to experts where needed to be able to produce it? Do you have actually enough information to produce valid inputs? Because if you do not feel like you can provide support to justify the reported figures, your assurance practitioner will also struggle. And so effectively, if from day one, an assurance practitioner doesn't think they'll be able to validate the information, an assurance practitioner will decline that engagement until the point that you are able to. And then the last three questions, really. The first of all might seem obvious, but it's always a challenge. Do you actually have a good first draft of your ESG report of that information? Does it have breadth and depth, and does it actually capture the right metrics for your industry, for your entity, for your users? Having decided what framework you were going to apply, are you very much comfortable that actually that first draft complies with the framework that you've decided, which is this criteria? Basically, did you apply the framework that you had selected and that you have disclosed that you've done? And are the disclosures in that first draft sufficient to allow a user to understand what it is that you've done? And finally, are you confident in the quality of the supporting evidence that you have? Again, to allow an assurance practitioner to validate the assurance report, the ESG report, you have to have access to that information. And overall, standing back, is your ESG report as provided that you're seeking assurance on neutral, factual, and complete? Ultimately, that is the materiality at the report level. That is really the stand back that the assurance practitioners will be doing. So if you can answer all of these questions for yourself and you're quite confident in your first draft, that's the point at which seeking assurance is probably a good next step.
Anna, thank you very much for that. We really appreciate you bringing that assurance perspective. So when I was looking at your slides and in speaking to you yesterday, to me it came back to, okay, so we are back to that ESG roadmap. So we're back to the start. In order to get ready for assurance, I think it's really important as we go on this journey that we have in mind the questions you've just asked. And in our roadmap, we try and address this, and we've tried over the 5 weeks to assist you. So, for example, we do reach out to stakeholders. We think who are the stakeholders. We put priorities on the various stakeholders. We reach out to them. We understand what their issues are. We consider how relevant it is. We look at the maturity of the organization around ESG reporting, whether we've got the systems, the processes, the data. Can we collect the data? And then when we get to the report, again, you know, is that final report a complete, neutral, accurate representation of what's happened in the organization? And then obviously we go on the improve stage. I think what's really important is I personally believe in the value of an audit or an insurance engagement, because to have a third party independent come in and question what you've done and provide suggestions or indicate, let's say, shortcomings that you could address is also an important part of the process. And remember, our focus is on continuous improvement. Really good for that third party to come in and point out some things that they think we need to focus on and improve on the journey. So where to next? Just a recap of where we are in Australia. So that preparation and disclosure of a sustainability ESG report is voluntary. You know, and we don't know for how long. We know it's mandatory in the US and Europe, but it's not in any law or legislation in Australia. It's market forces driving it at the moment, that access to capital, markets and people. There's no mandated reporting framework yet. We know there's a lot of the regulators are recommending the Tcfd disclosures, but that's just looking at climate risk. that's already embedded into the international sustainability standards, and they are continuing to develop more standards. They've got S1, the general one, and S2, and the climate one. And I've heard rumors that the next one is on biodiversity, but they'll deal with all the topics over time. So there's no mandated framework. We have the luxury of picking a framework, whichever one we want to use, which is most appropriate. And also no assurance is required, but I don't know for how long. And why I'm asking that question is, I've heard some conversations and I've read some comments that why would we mandate sustainability or ESG information to be reported if we don't also at the same time mandate some level of assurance, which I suspect would initially be limited assurance, as explained by Anna. So, you know, why would we have mandated reporting sitting next to an audited set of financials and there's no assurance? So there's some discussion around that maybe once the report is mandated, the assurance will also be mandated. Not sure, but that's just a lot of, you know, what I can see in the market or read in the market. And I think it's important where to next to think about your timeline. I know a lot of people attending the webinars have said, listen, 30 June 2022 was just too fast for us to get everything done, to get a sustainability report ready to issue it when we issue our 30 June 2022 financials, because a lot of our clients are struggling with staff shortages or staff having COVID or the nasty flu, etc. And it's just not been the absolute #1 top priority. However, I do think if we look at the media, if we look at what's happening in standard setting, it's time to really think about your timeline to prepare a sustainability report, that baseline report to start the journey. And also, as you think about that, a timeline around when do we want to get assurance over our sustainability report. And then finally, coming back to the point I've made earlier, Anna, and you referred to as well, is are you planning to phase in assurance? And is that scope appropriate? So if you want to do a sustainability report and in the first year potentially get assurance over 5 metrics, would that be appropriate? If that is the case, those 5 metrics will have to be the 5 key metrics. And not just the 5 easy metrics or the 5 metrics where you've got a good story to tell. So I think just to be thinking about your timeline around preparation and assurance and how can we get to continuous improvement. But the key thing is to get started. Ashley, I think this is a good time to launch our first poll.
I think you're right, Aletta. And I mean, what's obviously very interesting for us is we have our own views on how a lot of this stuff should work, but we're not in the position of everyone else, and we don't understand all of the factors pulling. So we're curious to know what all of you might think around this whole idea of assurance. And so we've got this question here: what's the most likely timeline for when you might consider obtaining assurance over a published sustainability report? So we know that some of you are already doing this, so we expect some of you will select option 1. Are you likely to think about doing this in the next 1 to 2 years? Are you likely to think about doing this in the next 3 to 5 years? Or is this further away for you? Interestingly, we'd like to know whether you think this is something that probably will never be relevant for you, not likely to never obtain assurance. So if you could have a go at completing one of those options, that'd be great.
So I'll allow another 30 seconds for people to contemplate and give us some feedback. I think all the attendees will be really interested to see what everybody's thinking. It is a journey, and it's a journey that is kicking off really fast in Australia. As I've said before, I've never seen standards being developed as fast as these sustainability standards. You know, accounting standards take years to be developed, and this is going fast. And Anna, I think on the assurance side, we're seeing something similar on how the International Audit and Assurance Standards Board have come up with guidance already quite great examples and working on a standalone standard and enhancing what we currently have.
Aletta, do you think the accountants have needed to take performance-enhancing drugs to be able to get these standards out so quickly?
Never, ever. Never, ever would we do that, Ashley.
Just checking.
Would never, ever do that. All right. I would say thank you very much for everybody that's voted. I'll close that and I'll share it so everybody can see.
Yeah, that's probably not dissimilar to what we had already discussed prior to this. Well, our expectation is this is likely to impact most organisations in the next 3 to 5 years, but there will be some outliers. So, well, I mean, we've got a very ugly bell curve there, but that's not unexpected. We would imagine most businesses will need to do something about this in the short to medium term.
All right, so thank you very much. Thank you for that. Thank you for everybody who's participated. Now, over to tax governance. David, you've been so patiently waiting, listening to everything around assurance, and it's finally your time to talk about tax governance. Now, when we talk about ESG, we always say, and I know the TCFDs say that you start with governance, and then you work down to risk management, etc. So governance is a broad topic, and I think tax governance is maybe one that we haven't talked about before. So thank you very much for joining us and sharing some of your insights, David. I'll hand over to you.
Just before you do, sorry, David, I'm impressed that you managed to get a photo of you backpacking in your 20s into the slide deck. That's nice.
Some of us have done some hard work in our lives, actually. Thank you, Aletta, and thank you, Ashley, for your lovely interjection. I actually look at this more in the context of sustainability rather than in terms of governance, although I think governance is a key pillar of it. And just picking up a few of the observations that have just been made, tax and sustainability is currently voluntary in inverted commas sense. And I say voluntary because revenue authorities around the world are not waiting for the development of standards around assurance reporting and yada yada, but rather they're developing their own. Many people who are on the webinar will have seen various ATO promulgations about what their expectations around governance and systems and processes are. We are aware that the OECD is spending a lot of time and a lot of energy around global tax-related issues. So it's only voluntary in the sense that it's not mandated that you have to do this stuff, but it's not voluntary in the sense that if you haven't attended to matters around tax governance and tax risk frameworks, there are outcomes in the way in which the tax office will look at the company, and they're already incorporating what they view as appropriate standards into their review. So it's voluntarily involuntary, if that's the right way of looking at it. So not a lot of what I'm going to say in the next 20 or so minutes is earth-shattering. Not a lot of what I'm going to say is novel, but I thought it'd be valuable to try and have a conversation about tax and ESG within a framework which sets a series of concepts and questions and doesn't just provide you with a set of answers, because quite frankly, there aren't a set of answers or a one-fit-all. So I've chosen a familiar diagrammatic. So if we might have a quick look at that. So this is about how one might go about building a solid house and how we might use that analogy in looking at tax and sustainability. And the first is to start, as most things do, with the overall strategy of the company or the group to ESG. Then secondly, if we can push the next button, what are the systems and processes and structures that we currently use in reporting around ESG, and draw on those for tax reporting as well. Next is, and this is so obvious that, and it's been said 100 times by tax practitioners and management consultants, is that you need to align your various strategies and approaches to what the overall corporate strategy is. So there's zero point in having a tax strategy which is unaligned to what the company or the group's overall strategy is. The overall objective is to have a sustainable tax function. And if you're building a house, you have those firm foundations that we've got below, you have a roof over the top, and then you have your key pillars. And the key pillars that I've put there today are a tax risk framework, governance processes, compliance reporting, and relationships with regulators. In truth, they're not the only ones, nor are they independent of each other. There's a high level of interdependence and overlap. But in discussing each of those, and I'll go through each of those pillars in turn, but the key themes that I'd like to draw out today is that you have to understand who owns the approach to tax, who's documented it, is it evaluated, and from the tax officer's point of view, how is all of that evidenced? Evidence is key in having any conversation with a regular tax regulator. So if I might turn first to the tax risk framework, and I'm just going to ask a series of questions or make a series of observations about what one needs to do when one considers a tax risk framework. And let me say at the outset, when the tax office now comes out to conduct a review of a tax return or a tax issue, they don't start with the tax return. They don't start with your work papers. What they start with is, what is your risk framework? What are your governance processes? How do you evidence them? What sort of compliance reporting processes do you have? How do you evidence that? And all of that then feeds into what your relationship with the regulator is going to look like. So let's start with tax risk management. What is the company's approach to risk? Now, many people might say, well, you know, we want to pay the right amount of tax. We don't want to pay too much tax. But that's a little bit airy-fairy and a little bit fluffy. So it's about articulating what's the goal, how is it evidenced, where is it articulated, who's documented, who's reviewed it, is it updated? And then it's about evidence about how this plays out in the day-to-day tax issues that the tax function deals with. How does that approach to risk management play out in the tax returns? How does it play out in the way in which you seek advice and on the issues on which you seek advice and from whom you seek advice? How does it play out in the way in which you deal with regulators like the ATO or the SRO? So it's not really, you know, that simplistic a statement about we want to pay the right amount of tax but no more. It's a more granular piece that the tax office are expecting corporates to have thought deeply through, to have articulated, to have had sign off by the board, and to then be able to evidence in relation to the way in which, excuse me, tax is looked at day to day, the way in which tax returns are prepared. How does the tax risk management reflect in the tax function? So how does it reflect in the size and capability of the people in your tax function? How does it reflect in the structure and budget that is provided to the tax function? How does it reflect in the number of board presentations that the tax people make to the board? How involved is the board in the setting of the tax risk framework? All of these issues, most companies will have thought about it, but thought about it in a more generic and conceptual way. What is becoming more and more important is that, one, it is clearly articulated, it is clearly owned at the top, that it cascades down through the organisation rather than up from the tax function to the board, that it is clearly evidenced, that it's evaluated. I think I've made the point quite clearly. And where does it sit vis-a-vis an ATO position? So the ATO has a view about what it expects. How does the group and how does the company, how does its view about tax risk sit vis-a-vis the positions that the tax office articulates in the myriad of publications that it makes? Onto governance processes, which really flow on from the same thing. What reporting is there around tax? What reporting is there to the board? How regularly is the reporting made to the board, and by whom is that reporting made? Is it made by a CFO or a CEO who might have a very high level understanding, or is it made by the tax manager who's dealing with the issue on a more on a deeper level? What's the level of the understanding that the board has? How actively involved is the board in making decisions? I had one client who had so many discussions with the tax office on a range of issues, none of which I was associated with, but the board had become so involved in understanding the tax issues that they set up a separate subcommittee of the board to ensure that they had sufficient understanding about the depth of the issue, the implications of the issue, not only for the financial statements and for cash flow, but for its relationship more broadly with government organisations. So those sorts of governance processes are really very, very important, as is evidence. You'll probably get sick and tired of me saying this, but in a lot of ways, the tax office has a view that says if it's not in writing, it never happened, and therefore you need to be able to document all manner of things around tax governance processes, including what controls you have and how they're operating, and testing those controls and evidencing the testing of controls, which comes back to a lot of the questions that, or the observations that Anna was making about, for those sorts of things, you need some measure of assurance capability. And it's always fascinated me that many companies have internal audit functions which do a lot of that sort of work in other areas of the company's business, but rarely does an internal audit function have a conversation about tax and tax processes and tax controls. And in part, this is because we tax practitioners have promoted for a long time that tax is a dark art, and unless one is sufficiently au fait with the dark arts that you won't understand. Well, quite frankly, tax is no different to any other skill set, and when one peels away at the onion, you'll find the kernel of the answer there. So I don't think it's appropriate anymore for tax practitioners to promote the notion that tax is a dark art, and I don't think the tax office thinks that boards should settle for that as an approach. Compliance reporting. This is really where the rubber hits the road. What is the goal in preparing a tax return? And a lot of people will say, well, I want to lodge a correct tax return. I don't know what a correct tax return is. A correct tax return, any tax return draws on financial data sitting in the financial records and ledgers of the company, but it also draws on a whole series of other matters outside the ledgers. It requires an assessment of judgment and risk. It even requires that the stuff that goes into the trial balances in the first place is right, and no one's going to give you 100% assurance around that. So to those that have this expectation or aspiration is probably a better way of putting it, an aspiration of a correct tax return, I think that aspiration needs to be left to the side of the road. I think what's important here is understanding what an auditable tax return looks like. And this comes back to the issues that Anna was talking about again about, so what assurance processes do you have, what processes do you have in the first place? What assurance do you have about those processes and about the data that is coming out of those processes, and then how it's manipulated into tax returns? Does your tax return reflect your tax risk framework and your governance frameworks? This is where all of this stuff becomes quite interdependent rather than independent, as I've shown it in a diagram, but I didn't want to have a series of Venn diagrams everywhere. That would be a little bit too difficult. What systems and processes do you adopt in compliance reporting? Are they informal processes that sit outside the system? I had a conversation one day with a young guy who'd just been promoted to a tax manager of a reasonably important or sizable superannuation fund, and all of their tax information that went into the tax return was sitting in a series of spreadsheets that have been developed over time that drew from various parts of the trial balances, but was not capable of being audited. Some of the stuff was hard-coded, and those sorts of systems and processes are not, they still exist. And so there will be a lot of people that sit there and go, oh, I don't have that sort of problem. You know, mine is fully auditable. I think anything that sits outside the system in like Excel spreadsheets and the like provides a risk around compliance reporting, and it's a risk that this is where the tax office looks for areas of risk. They're not looking for necessarily I've got a problem here. It's an area of risk, and therefore it's an area. If there is an area of risk, that's where they'll focus their attention. Timeliness of reporting. This is becoming much more important, particularly for members of significant global groups, what the tax office calls significant global entities. So if you're part of a larger global group that has revenue exceeding $1 billion and $1 billion per annum, and there are a lot of them, your compliance reporting and the timeliness of your compliance reporting has now become more and more critical. The tax office is able to levy fines up to $500,000 per compliance filing that is late. So it can be a day late, it can be up to $500,000. Now, in the first 2 years, they were reasonably flexible. I had 2 clients who had a little bit of an issue around timeliness, and not understanding that whilst their operation was only a $20 or $30 million operation, they were part of something larger, and they did get hit with a $300,000 fine. And it does take a fair amount of effort to be able to get those fines reversed. The important thing is not, well, the fine is important, but that's not the most important thing. What you do when you lodge something late and you're an SGE is that you're telling the tax office, my systems and processes are not up to par, and therefore you're more likely to get a review than you're not likely to get a review. One of the other things that when we talk about tax, we tend to focus very heavily on income tax. Does the compliance effort that your company is dealing with reflect the risk around things that are not income tax but tax related anyway? And the things I'm thinking about here are payroll tax and superannuation reporting. There are many instances that have been well reported of groups whose whose brand reputation has been not only sullied but destroyed through a lack of attention to appropriate reporting around payroll tax, around paying people, around superannuation. In my view, this is an ESG related issue like anything else. This is about the sustainability of your business, and this is where tax and sustainability collide. Is there a risk that you've got the tax impact that is fundamental to the key assets of your business? And my last one around compliance reporting is the extent to which there is training and development of your people. Too often we hear of, we see companies employing tax managers and putting them off to the, let's hope like hell he doesn't find anything, he or she doesn't find anything. It's a set and forget sort of thing. Compliance reporting is something that needs constant evolution. It needs constant training and updating. It needs constant attention to its systems and processes. All of these things then feed into what's my relationship with the regulators like, and what's the preferred type of relationship that I want to have, and have I documented that? So do I want to be seen as being compliant with everything that the tax office wants to see? So that would include all their statements around justified trust and tax risk frameworks and governance. Do I want to have all those things? Or on the other hand, do I want to have am I happy to have a vigorous relationship with the tax office that reflects that I have a particular approach to managing risk? I'm going to stick by what that assessment of my risk profile is, and if the tax office doesn't like it, then that's their business. This is actually where the development of your tax risk framework and your governance processes actually starts. What sort of relationship do I want to have with the regulators, and how do I evidence that that's what I'm doing? Am I engaging a tax manager who understands that? Does my CEO, my CFO understand it? What happens if there's a change of control of the board? How do I better reflect what that change in circumstance looks like for the relationship that I want to have? So in closing, I'd like to make just a couple of quick comments. Building a sustainable position on tax requires a view on each of these key pillars. It can only be truly sustainable when it reflects the overall corporate position, that it's documented and exercised. By exercised, I mean it's tested, and that it's reviewed and evaluated. And I suspect, lastly, it needs to be contemporary. It needs to reflect changing social mores, which is largely what ESG is about. It needs to reflect changing views of the regulator. It needs to reflect changing views about, just within the organisation. What's the board's view about these things? So hopefully I've given you a little bit to think about. I never expected to be giving you answers, but hopefully there's enough for you to think about in all of that. So I'll pass back to Aletta and Ashley.
David, thank you very much. I think the fascinating part is the great overlap between the things that Anna talked about around assurance and all the themes coming out of your presentation. So thank you very much both to Anna and David. I thought we'd do a final poll. Ashley, I'll hand over to you to maybe talk through this one.
Oh, sure. Happy to. I'm happy to be quite quick. I know we're out of time. So for those of you that need to move on to other meetings, obviously feel free to do that. For those of you who just have 2 more minutes, we'd love to know your thinking around some of these key sustainable tax issues. Now, as David said, these are all interdependent. But to the extent that you can prioritise one of them, which of those 4 pillars do you think is likely to be the biggest priority for you? So that first one around risk frameworks, the second one around governance processes, the third one around compliance reporting, and the fourth one around regulatory relationships. I don't know whether David said I might have a rigorous or vigorous relationship with the ATO. I couldn't work out, but I suspect I probably want neither in the long term. Which one was it, David?
It could be either or, Ashley.
I thought so.
So again, thank you very much, everybody sharing their thoughts. For me, it's always fascinating to see what your thoughts are. You know, we talk internally at BDO, we've got some ideas, but it's great to be able to test it with all our webinar attendees. Obviously we share it with all of you because I think it's great to see what other attendees are seeing, experiencing, and what their focus is. So thank you very much for participating in that. We really appreciate it. I'll close that one and share the results. David, what do you think about that? Regulatory relationships are very small percentage.
Yeah, well, that might be, of course, because everyone has already determined what their desired regulatory relationship is. The thing that interests me is the extent to which compliance reporting gets the biggest response, and perhaps that's because that's where the other two, I said at the start, that's where the rubber hits the road, right? And
yeah,
thinking more broadly about what compliance reporting should look like that to me is a key issue, and maybe it could reflect the importance of proper systems and processes around those things like payroll tax, where there has been a lot of problems in recent years that have caused irreparable damage to brands and the sustainability of companies. So at first I was a little surprised, but on reflection, I'm probably not.
Thank you very much for that. So again, thank you very much for everybody, for Anna and David sharing their insights. So if you need any assistance, please remember Tcfd Disclosures. We've got free online training available on our website. This is Tcfd Disclosures are the disclosures recommended by ASX, APRA, ASIC, currently in Australia, for inclusion in 30 June 2022 financials, I might add, in the OFR. We also have our monthly corporate reporting insights that will be going out early next week, the August edition. And we always have a number of sustainability and ESG articles in there. On our website, a lot of information and also how we could help you, and in particular, all the partners across Australia that could be helping you. I'm thinking one of these days, I won't be able to fit all the names and faces onto the slide, because as we explore sustainability, you know, it's just more and more service lines getting involved, more and more services, more and more partners. And I suspect that's what we'll see at clients as well. It's not contained to one area, it's across BDO, and it will be across most of our clients. But please feel free to reach out to any of us. Thank you very much for your time today. We hope you join us for our next series of 3 webinars. We would love to speak to you. I'll see you then next webinar in October. Thank you, Ashley. Thank you, David. Thank you, Anna.
Thanks, Aletta. Bye-bye.
Bye.